But let's talk about the global cues. Of course, the headline is what happened with the US market because of Apple, but there are more cues to track as well. Here's Mangalam with the world view.
Absolutely. So there was a near 700-point decline on the Dow Jones yesterday, along with S&P and NASDAQ losing about 2.5 to 3%. The biggest culprit there expectedly was Apple. In after hours trade, it was down 8%, but yesterday it fell about 10%, worst session since 2013. In fact, Apple lost about $75 billion in market cap just yesterday, which is equivalent to the market cap of Infosys plus HCL plus Wipro. However, as a result of Apple's guidance on muted growth coming in from China, the other China sensitives, the likes of Caterpillar and Boeing, too fell by about 4%. What did not aid the sentiment further was the weak manufacturing data that came in, 54.1 in December. This compares with a poll of 57.9. Another pain point in the US was Delta cutting its guidance for the fourth quarter. So that stock was 9% lower. At the same time, we had American Airlines and United Continental on the back of that falling by about 5 to 7.5% as well. Across the Atlantic, the European markets not doing too well as well. A near 1.5% cut seen on the DAX as well as the CAC. The British index too low by about 0.75%. In Asia, Japan opens after a long holiday and it's down about 3%. The dollar yen, while it is weaker than earlier levels of sub 106, it is still stronger than the levels that we saw previous month, say about 111, 112. Not good news for Japanese exporters. The Asian markets, while they opened in the red, now seeing a lot of recovery. The Hang Seng actually at the high point of the day. For us, the important data points will be: one, crude is back around that $56 per barrel mark, above $55 per barrel mark from earlier lows of $53. And the SGX Nifty, that one should come for you, indicating a mildly tepid start.
Okay, all right, Mangalam, thanks very much for that. Well, let's take the global context forward and get some thoughts in. We have a guest joining in now on this global slowdown worry that's really spooking markets, with the Dow falling again, as we just told you, over 600 points overnight. Let's get in a word now. Mark Matthews of Bank Julius Baer is joining us on the phone line. Mark, good morning. Thanks so much for taking this call. It's not a great start to 2019 for the U.S. market, is it? Already down 3%. Is there a serious case of major growth slowdown that's now coming in?
I don't think so. That's why I find the move in the market surprising, because the data does not suggest a recession this year. We can't, economists can't really predict very far into the future, but we are expecting some kind of a mild recession in 2020, but I think it's too early for the market to panic about that at this stage. I think what the market is simply reacting to is the fact that there is some deceleration in growth, and that's entirely normal, because just taking the ISM Purchasing Managers Index, which you were referring to earlier, going from 59.3 to 54.1, yes, it seems like a very big drop. It is a big drop, but it's extremely rare that you get the PMI at 59.3 for a prolonged period of time. That was not something that was sustainable, and we should have known it wasn't sustainable. And 54.1, I would remind you, is still a very healthy number for the PMI. Anything above 50 obviously signals expansion. So sorry, to long-winded answer to your question. I don't think that the U.S. economy is weak.
Okay. Good morning, Mark. It's not weak, it's the delta. It's weaker than what the market thought it is, that's all. Or it's not as good as what the market thought it is. And it's combining with the largest economy and the second largest economy in the world also showing distinct signs of weakness. What Apple tells us is a very clean number. It's cleaner than perhaps all the PMI numbers, because it comes from a company and it's saying that they are cutting their earnings from whatever 91 billion to 84 billion. That's quite a drop. If you put both these large economies, their delta indicating slower growth, do global equity markets have to correct a little more?
I don't think they have to. I think the S&P, as of the close of trading yesterday, down to 13 times this year's earnings. If you look back over the last 30 years, the average price-earnings ratio was 17 times. It is not an expensive market. as much as the ISM, it's true it was a big move, and so the delta really stood out in that. I could cite you many other economic data in the U.S. which are still strong, and I'll do it right now. I'll just tell you retail sales ex-autos were up about 5% from November 1st to December 24th.
That's right.
And that's the strongest it's been in 6 years. So the only thing I guess I would kind of agree with you about is the Chinese economy is continuing to slow, and that is the major driver of global growth, and that is a problem for the whole world, including the U.S.
Okay. Mark, hi, good morning. What about India? It was an outperforming market all through December, and not only did it outperform the developed markets, but even in the emerging market peers, it was one of the best markets. There's been some correction. Are you bullish on India, or you think it would sort of underperform, and perhaps there would be some mean reversion?
All I will say is that it is difficult for the emerging markets, including India, to rise when the U.S. is going down. So the U.S. is going down right now. And, we just have to look at the screen today to see, the other emerging markets that are open are trading down. So I don't think it can be, isolated and somehow go up in absolute terms when the rest of the world is going down. Within India, I see positives and negatives. The largest positive, clearly the collapse in the oil price will take a lot of pressure off of inflation and the central bank. On the opposite side, we have the election coming up. So it just sort of balances out to me.
No, Mark, just to prod that point further, the election season has led to a lot of competitive freebies being offered by rival parties, and on discussion is a large package for distressed farmers. The very talk of that has raised the 10-year bond yield from 7.25. It got to 7.25 because of the fall in crude prices. It has taken it 20 basis points higher to 7.45 yesterday. Will that be a worry? Will that be a factor when you're buying stocks in India, if you are?
No, I wouldn't see that as a factor because it's clearly temporary. It's just pre-election goodies. So in other words, it's not a structural component of inflation. But the thing about the election that I just find, I don't know what the right word is to use, worrisome maybe, is that Modi's election was so unusual a few years ago that, although people say elections don't have any impact on the stock market longer term, there's plenty of data to suggest that. I think this time it's a little different just because the Prime Minister is so very different from what we've had in the past.
Okay, Mark, thanks a lot for your time today. It was good talking to you. Let's take this discussion forward then. We have Adrian Mowat now joining us, well-known emerging market equity strategist. Adrian, good morning. First of all, Happy New Year to you. I think I'm talking to you for the first time this year. Your thoughts on how 2019 could shape up for emerging markets, especially India?
Yeah, Happy New Year. Look, I want to make a quick point about the US and US data, just following on with what Mark said. So the ISM numbers, the retail sale numbers, are pretty good. I mean, particularly those retail sales numbers. Now, with regards to the employment numbers, these are going to be interesting ones for the market to interpret. I think the market would be better off if the employment numbers were poor, because the thing that's driving the Fed is this tight labor market in the United States. And one of the reasons retail sales are strong is because there is good wage inflation. And so I think the best thing for the market would actually be a bad unemployment print or a bad job creation print when we look at the numbers. And if that comes out, I think that would then certainly move the consensus on the Fed. It's also important to remember with the Fed that you do have a new chairman in the Fed in terms of Powell. So the market's really getting used to his communication, and his communication has been frustrated by President Trump politicizing the Fed. So in making those points and moving on to emerging markets, I think this case for emerging markets is pretty strong for 2019. You're beginning to see some dollar weakness, which is part of this story with regards to Fed expectations. I remember the dollar was pricing in a number of increases in 2019, and it's in the process of removing those increases, which probably does mean that the dollar has peaked and might weaken throughout 2019. And that certainly will take the pressure off emerging markets. I think Apple's news on China is probably not a surprise to Asian-based investors. And you can see the way the Hang Seng is trading today. It hasn't fallen in line with the US market. Admittedly, it is very volatile, but it hasn't just gone down the same level as the S&P. And we've been watching Chinese equities fall since their January 2018 high and know that the Chinese market is pretty weak. I think what the Apple number does is it makes this a globally discounted factor, which probably sets China up for quite a good year for the stock market as the easing that started to occur in the second half of 2018 begins to take effect. So you've got the market discounting a very bearish view on the Chinese economy. And I think the delta going throughout 2019 is going to be an improvement. And I think broadly, we can say that across emerging markets. I'd reiterate the point Mark was making. For the Indian market, we had concerns about inflation, the current account numbers, the central bank there being forced to continue to raise rates. All those negatives have been removed. And possibly the monetary environment, particularly if the dollar is weak and US long-term rates remain low, will turn out to be a little bit more accommodative than economists have currently got in their numbers.
Okay, actually,
so I think
Adrian,
it's a pretty bullish story for emerging markets.
Yeah, when we last spoke, I think it was last month, Adrian, you were you were a little more bearish on India. You think the situation has changed for the better, and now you would start buying India next only to China?
Yes, I think the biggest delta in terms of equity share prices will be in China. Remember that India had a reasonably good 2018 relative to its peers in the emerging markets. So I think in terms of recovery trade, it's probably going to be better in China. But I think for Indian-based investors and also international investors, you're going to make money by being long Indian equities this year. But I do think that if China gets a reacceleration in growth and obviously this is very difficult to predict, particularly how unstable the White House feels at the moment, but if you were to get some resolution on the China trade conflict, then I think the biggest upside would probably be in Chinese equities within EM.
Adrian, good morning and Happy New Year. So you've brought us good tidings, actually. This is good to hear because you're predicting a Goldilocks scenario in the US continuing and a revival in Chinese growth. So if those two global factors play out, and generally it's a great year for global equities, then within India, we might underperform, but within India, where should one be in? I mean, what are the sectors? You did speak of cyclicals last time, but what are your best chances of making money in the Indian market?
Yeah, so I mean, you were referring to Bajaj Auto a little bit earlier in the program. It's some of the domestic cyclicals that I think I'd be most interested in. But also, we've had the tech sector being hit very hard globally in the fourth quarter of 2018. So I think, Indian tech, if we get a recovery and people's confidence in global growth, should do well. And, you were commenting earlier about whether it's right to be buying into the bank index. If investors are feeling a bit more confident about EM and Indian growth, then that'll also be reflected in the banks. So I think you end up with a relatively broad rally, but my preference, if I could find it, would be more towards domestic cyclicals.
Okay, in that sense, Adrian, what about the broader market in India? We had a sharp correction last year after a massive rally in 2017. You think we could have a broad-based rally this year?
Well, broad-based, you mean including the mid-caps?
Yes.
I think the mid-caps, you tend to get a larger exposure to domestic cyclicals. So at a strategy level, that should work. I wouldn't expect the mid-caps to lead the recovery, though. Typically, it does tend to be the large caps. And, you know, at this sort of consolidation phase that we have after the sell-off, you will continue to get a degree of redemption selling going on, which I think is a very important factor, particularly in January after a very poor fourth quarter. And this is a global story. And often that results in some quite extreme moves in mid-caps. So I like your idea of buying into mid-caps, but I would be cautious about doing that as my first sort of commitment of new capital. I'd wait for the large caps to show the stabilization and recovery before committing too much capital to small caps. But that's more a technical statement rather than a fundamental statement.
All right. Adrian Mowat, thank you very much for joining us, and have a great 2019 yourself.
You too. Thank you.
Right. So the long and the short, actually, this is precisely what Chetan here was also making, that you may see a US slowdown, but China, because of the fiscal stimulus all through last year and now, and perhaps some kind of a trade agreement, because now President Trump would realize a Chinese slowdown is hurting US as well. So an outcome would come. Therefore, even he was making the point that China, India and Brazil would be the countries he would bet on in 2019.
And I think the market's shown some signs of, you know, the US is in a bear market, and for still, you know, the emerging market universe to still outperform. It's giving you that sign, perhaps.
Well, maybe a lot of that is already sort of working its way into stock prices today, because the Hong Kong market's up and about, the SGX Nifty has turned positive. Let's take a quick break on that note. On the other side, we will boil all of this down to the micros, the stocks that should be on your radar this Friday morning.